Welcome back to Money Discourse. I know it's been a while since we last came to you, but I tell you what, our portfolios are doing so well. We're just, taking it easy now.
Basking in the sunset.
Exactly, yeah. But yeah, markets finally take a breather following encouraging inflation numbers and earnings have gotten underway. But how frothy is this market? You see AMC and these other names going nuts. Rajan, is the meme craze of 21 back?
Sure seems like it. I mean, we've seen a bit of a shift in the type of meme stocks, and again, it's just, but the underlying message is the same. These low float stocks, they're trying to just pump it up, and the biggest beneficiary is Carvana. Now, I've been shorting Carvana quite a bit, and those who follow the average trader portfolios saw that I took a bit of a hit on that one. But I took a
Money
bit more
discourse,
of a hit.
money discourse.
Yeah, money discourse, right? And the thing is that it was, and I've shorted it again, although look, we saw good numbers out of them. They did strong EBITDA, but they're making $6,000 to $7,000 profit a car, like per sale. It's unsustainable. They obviously got inventory quite cheap, and and some reason people are buying it. And then at the same time, the financing rates are so high, probably commissions, and I think all of this is unsustainable. But anyway, other than that, I mean, you're seeing meme stocks. To be honest, I don't even know what half of these tickers are. I'm looking at FinTwit, and all you just see is some random ticker up 70%, 90%, 110%. But then when the good old AMC came back on Friday, after the close, mind you, and then basically there's the ape preferred stock deal had been rejected by a Delaware court, which was quite a surprise, and that really shot the stock up. And bear in mind, it was 4, and I don't know how much the ape stock is worth, but and I don't actually know the exact details of this, but anyway, it went up to around about 8, and I think it's settled around 6.5, 7 or something like that. So I mean, there is just a lot of money pumping this up. The option activity is wild, and it all just feels like all the fear. Like, we were saying, let's just take Tesla or any stock. No one wanted to buy Nvidia when it was 120, but they can't help buying it at 450. Same with Tesla when it goes down to 100. I mean, sentiment is everything. It just when the going gets good, FOMO is just incredible. But I saw this amazing stat, and I'm pretty sure everyone who's on some type of social media saw it too, that the S&P is up. Oh, I forgot. It was about like up 18. What is it up this year? But it's up at like 18 to 20% or something. The top 7 stocks account for about 58. They've moved around 58%, and the 493 remaining S&P 500 companies have gone up 4%. Now, we spoke about this before, but you could just see how distorted this whole rally is in literally these big mega fang names, and obviously tech names, which the NASDAQ has totally outperformed. It's AI, is tech. We spoke about this last time. I mean, AI has been around for a while, but just the way in which ChatGPT has totally changed the hearts and minds, and the processes in which so many people are doing things, and the adoption which is all happening, has really been filtered through into the stock market. And we've seen this huge rally. But you might have these dividend stocks, but you look at stuff like AT&T is at 13, 14 bucks. Verizon is at 33. If you don't have those big core tech names in your portfolio, you're pretty much missed out.
Now, my question is to you, Rajan. Where do you think this NASDAQ rebalancing is going to take the market, especially with the fear that less capital allocated to the largest companies? Do you think it's actually going to really change the whole makeup of the allocations going forward? Or do you think that the money is going to still flow into all of the largest cap stocks?
It's funny that you said that, because there was an Economist article sort of detailing this straight away. The whole point of an index passive investing is that you want a broad-based basket, right? And the thing is that all of these baskets, especially like the NASDAQ 100, the S&P 500, they've become so concentrated in such a few names that you really don't have no diversified risk at all. You're pretty much, your performance hinges on how well Apple, Google, Microsoft, Tesla, Facebook, Meta, they're all doing. So to be honest, this had to be done because, a prime example is the Swiss SMI, right? So I don't know how many stocks are in that index, but like Novartis and Roche and Nestle pretty much make up like a gigantic part of that index. And so if Novartis is down 3%, the whole Swiss index is down almost 3%. And it doesn't matter if the other ones are all up. It's just so concentrated in those names that I wouldn't really even call it an index. And then if you look at the top 5 or 6 stocks in the NASDAQ, make up over 50% of the weighting. And bear in mind, there's 100 stocks in it, even though you can actually get the QQQE, which is the equal weight. But the thing is that I don't think it's going to really change performance that much, because I think tech in general is just booming. And if you look at a lot of these underlying names, a lot of them are going up as well. But I think it is necessary, because I also think these big names are being distorted to the upside because of passive investing too, right? And it's sort of running way ahead of itself partly because of the allocation within the passive investing side, as well as everybody just wanting to get into there and trying to get their allocation so they don't miss out on this rally. Because again, a lot of these fund managers, they have not even kept up pace with this rally this year if they don't have exposure to these names. So there's a lot of these catch up that's going on. But I think it'll all play out. Personally, I think I've said this to you before. I think the AI technology and what is happening is the real deal, but the move in the market is a bit of a bubble. And so that is my opinion. So I'm not doubting the underlying technology and everything that it's doing for people, but the way how, for example, when Microsoft announced the pricing of Copilot 365, the stock went up 5%, adding 130 billion to the market cap when it's already worth 2.6 trillion. Again, only time will play out whether it's justified in that way, how many people take it out. But again, right now the market is, it just, the algo's on full swing, just buying up these stocks like crazy. But yeah, so I don't really think it'll have that much of a problem, but I guess we'll find out. But this week and then the end of last week, we had the start of earnings. Primarily, we had a lot of the big banks, and pretty much most of the big banks reported strong results. JP Morgan, Bank of America, all of them. Bank of America has been up about this week, I think around 9, almost 10%. And Morgan Stanley was up 7%. And then you've got a lot of these regional banks that were also up quite a bit. We had Charles Schwab, that was up like 14%. So a lot of the fears, I mean, that whole banking crisis didn't even seem like a crisis really, because it sort of just happened, got fixed, and then boom, we just moved on. The Fed did its job. They came in, rescued. But we did see some weakness, like with Taiwan Semiconductors, we got these spending shifts. But obviously the two big ones in terms of retail interest anyway was Netflix and Tesla. And both of them had similar reactions. Both got pounded after earnings. Tesla was down almost 10%. Netflix, I think, was down about 7-8%. So being a Tesla guru, what did you make of it all?
I was completely expecting this move down. The movement in stock price over the last couple of weeks has just been, I guess, a bit too, well, it's unsustainable really on how much it went up. And we expected to pull back. I think it's now like 9 out of the last 11 times after earnings, there's always a stock drop. And, I think the expected move was supposed to be about 7.8% or something like that. We obviously got 10, which makes sense. Obviously, a lot of profit taking, and the sentiment on the call was obviously, very cautious from Elon and the team, obviously not guiding in terms of a bottom in the cogs basically. So, but one thing that we have to say is that, like, we all know how cyclic the auto market is, but like, Tesla's earnings really just show how resilient Tesla has become as a company, because from like 2010 to like 2020, because there wasn't any like big recession at that time, that could have taken out Tesla. But now we've got to a point where luckily it's come at a time where they're just a powerhouse. You'd think that there's like Indians at the helm running Tesla, like being cheap and stuff, because the way they deploy their capital, you can see from the earnings, like they're really, really ultra efficient, I guess, in that. And even though they've lowered their costs drastically, they have still decent margins, even though like the auto gross margins are below forecast. They're still selling pretty high margin products and still made a boatload of cash. But I think the real takeaway here, I think if you are an investor or looking to become one, is what gives Dan O'Dowd sleepless nights, right, is literally the industry now acknowledging that not only is Tesla ahead in charging manufacturer, it's really ahead in software and autonomy, and that's where Elon announced they're in preliminary talks with one of the largest automakers. So they're all kind of bowing down their heads and saying that Tesla Autopilot is safer than all of the other ADAS systems, right? If it's just the most basic, not full self-driving or anything like that. So if that software goes onto a lot of, say, into all Ford cars or whatever, and Tesla even just makes $1,000 on each car, or even $500 on each car, literally it's the software, which is almost 100% profit, right? They're told where to place their cameras, and that's pretty much it. Their software will handle everything else. And I think that's just, it's like another S curve that Tesla can ride up. Tesla, I think, will come to a point where like at least 25 to even 33% of all cars sold is running Tesla software, right? And the thing is, like, all of these automakers, they license all of the ADAS systems they get. They don't program themselves. It's done by Bosch. It's done by all of these other third parties who, they have to bolt on their things. And the thing is, none of this stuff updates over the air. That this type of stuff usually doesn't get much better. I think that's like such a key takeaway. Elon on the call, he started going on some, tangents, and like he didn't give Wall Street what it wanted to hear, which was basically, margins have bottomed out and things are going to be on the up from here. But I think Elon doesn't care about that. And I think really third quarter, I think it's still going to be a little bit tough for them, but they've put this kind of little nugget on for anyone who does have full self-driving like me, an older car. You can actually move it to a brand new car if you purchase something directly from Tesla. So then that should also, like, push a bit of a wind into their sails. But I think the Model 3 especially is getting a little bit old now, and they obviously need to do something to spruce it up. So I think that refresh is coming in Q4. That's why they're doing this limited FSD transfer in Q3 right now. But yeah, Cybertruck's coming. Obviously really interesting to see what the pricing is going to be with that. And
so you know what it is. I think, like everything you said, like playing devil's advocate here, I mean, everything that you said is why Tesla's worth almost $1 trillion, right? And it's worth like 800 billion more than any other automaker. So the question is, this is already like what is expected. And everybody looks at the share price, but people sometimes don't look at the valuation. They go, oh, why is it going down? It's going down because there's $1 trillion, right? And what it reported was very average relative to what it's worth. And so the thing is that in itself, if you didn't look at it as a basis of, it's like buying paying 100 grand for a car, but it just doesn't feel like 100 grand. So it's like that type of thing. And then so just just for those who didn't see it, basically Tesla reported a beat on top and bottom line. Their op margin dropped almost 50% to 9.6%. So it was down almost 5 percentage points. And adjusted EBITDA margin was ahead of consensus, but their GAAP gross margin was below. Their automotive rev, don't typo. There's a lot of typos. If people see me, I'm trying to do it so fast, there's typos, but that was ahead of consensus. Their free cash flow, although it was really good, a lot of the analyst notes really pointed to that the free cash flow and the cash flow generation wasn't as what they expected. And but they did note that they're focusing on cost reduction and the stock is flat. Now, just like you said, I think what caused the drop off is that they didn't acknowledge that the price drops would stop where they were. And then he left the door open that there could be further price drops coming ahead in the second half. And then that's like further margin erosion. And so the whole idea is if they have to keep on cutting the price of the car to try to hit their targets, because they pretty much made it clear that volume over profits is their goal. So they want to hit that 1.8 million forecast for this year. So they are going to cut the price of the car as much as they can within reason to reach that target. And that is their goal. And because Tesla's had the big margins, that is a lot of what drives this valuation. And this is what a lot of these analysts are concerned about. But again,
it makes sense. It makes sense, that strategy, because the more volume you produce, the cheaper it becomes to produce a car, right? And then that just becomes a self-fulfilling prophecy on that. So yeah, I completely understand what you're saying, but
this was, you know what, it makes sense, but this is why the stock dropped.
Yeah.
And the thing is that, but like we were speaking, the stock only dropped to where it was before their Q2 delivery numbers. So it's when you've had such a mad run up, right, you sort of lose track that literally if you go back a week and a half, 2 weeks ago, this is where the stock was, right?
Yeah. And the only people that are really mad about it are the people that bought it when it went to 290 just now. Right? It's like, oh, why didn't it go up further? Obviously, like you said just at the beginning of the program, people who had the opportunity to buy these stocks at much lower prices when the sentiment isn't as good.
The one thing I would say just before we move to Netflix is just in general, I've been tracking the Q2 delivery numbers for all these automakers from all around the world, and everyone has been smashing it. But in the EV space, we clearly know that Tesla's ahead. But Volvo and BMW, I was shocked, like how much penetration they're getting. And in terms of, obviously, Tesla's got the whole ecosystem behind it, and their valuations mainly, derived of their, FSD potential and the other bits and bobs that they got. But BMW are making real good margins on the cars that they're selling, the i4 and the i7 or whatever. And the thing is that, and then we saw that other headline with Volkswagen, how people don't want their cars, but yet they sold 165,000 in Q2 led by the ID4. So then it was like conflicting headlines. So I mean, Tesla was the first automaker to report, but this week we got GM, we got Ford, in the US. We're also going to get the European picture as well. So what I'm looking out for is what are their margins like, given that Tesla have dropped their prices so much. Like how much have they had to cut their prices in reaction to that, and have they had the same effect in terms of their margins? So that'd be very interesting to note. But so the other big one, Netflix. Now that's another one that's had a mega run. Now we all remember when Bill Ackman took that big stake at around 220, and then he took the loss on it. And it went down to 170, 160, and then next thing you know, it's near 500 again. So it's just another one of those huge tech, big tech names that have had this huge rally. And again, their earnings were mediocre. And normally Netflix rallies on their streaming numbers, and their EPS and revenue isn't really a big deal, because I've seen their EPS and revenue miss so many times. But because their streaming numbers were higher, the stock rallies. But it's the first time I've seen the opposite, where if we actually look at what Netflix did this quarter, they reported 329, but their revenue of 8.2 billion missed slightly, and their guidance for Q3 revenue also missed. And but their paid net ads, they're expected to be similar year on year, and they affirmed their operating margin target. Their paid memberships was above consensus. Their paid net ads 5.9 million for the quarter, which is well above the 2.2 million estimates. And in United States and Canada, their net ads were 1.2 million. The street had forecasted for it to be flat. So a lot of their net additions were in the States. So it really did came in stronger than expected. And pretty much all their regions, like even EMEA, 2.4 million additions, well above the 0.5 million. That was the consensus. So you can sort of see that Europe and America, which is actually their most priciest segments in terms of their subscription, actually had the biggest beats in terms of their net additions. So I don't know if that's to do with the password sharing or whatever it was, but normally that type of data would push the stock up through the roof. But when the stock has gone from, low 200s all the way to 470 pre-number, this is the type of reaction you're going to get. And I think we settled down at around 430 range. So we had that move down in Netflix. But again, it's interesting, the reaction, because there's two stocks, Tesla and Netflix, that have had this huge run up, and pretty much they had earnings. They weren't stellar earnings. They were just in line. They didn't smash it on all ends. And next thing you know, they both come down quite heavily. So it seems like this market is, you've got to beat on everything and then guide it through the roof to continue that momentum. Otherwise, we're going to sort of come down a little bit, So
or you need to beat AMC.
Oh yeah, but the difference is with AMC, it was $4. Like so what is happening is that a lot of these stocks that have been absolutely pounded. I come back to Carvana. That stock at one point, I think it was like 300, and it went down to $2.50, and then now it's at 50 odd, right? So it's a lot of these fallen angels. Well, I wouldn't call it an angel, but a lot of these stocks that were pie in the sky have really been beaten down, and then they're getting a lot of momentum. So I saw this headline, like ARK is had the best run since that, because most of her stocks have been absolutely smashed to the ground. So obviously they're the ones that a lot of the rally has been focused on, these bottom feeders, and so quite naturally ARK's going to go up. So it's not like she's outperforming. It's only because she was underperforming so much that naturally you're getting that bigger bounce. So yeah, but I mean, next week, yeah, there's a good chunk. It's going to be very interesting and very busy. Like Monday, as usual, was quiet, but yeah. So we'll get a lot more read through on how it all goes.
Yeah, I mean, what's sad about ARK is that it's obviously down. It's down like what, 70% from its high. But if you had put it in 5 years ago, only now you're just in a couple of percent profit over 5 years. Kathy goes on about how we're just on the verge of disruptive tech. If she didn't have Tesla, just imagine.
Yeah, Tesla is the biggest holding. You wouldn't be up 2% in 5 years. You'd be down 50%. But one thing about in my opinion, it's all good, being a fund manager, doing this, doing that. It's all good thinking what is the next disruptive tech. But also the art of there's one thing about being an analyst. So if ARK was just pure analytical, which they are, and they put out the good research and they go, this is the next big thing. Ginkgo Bioworks, which she is loading up massively on, buying 1 million shares every time. It's going to be the next big thing. And doing that research, that's one thing. But then buying all these stocks at $15, $20, and buying at valuations of 4 billion, 5 billion when they were doing zero revenue, like that's just not astute. That's just called bad trading. So there's a difference between having good research and really calling out what companies can be the next best thing, but then buying them at the most ridiculous valuations, which then puts your fund at a real disadvantage that doesn't give you the credibility. That's why all these analysts at these banks, they're great, because you know what? There's this, I found it quite funny because I was obviously looking at Carvana since I got position on, and I was looking at some analyst notes, and one of the analysts, it's actually quite funny. Which one was it? Let me see if I can find it. They still haven't underperformed on it, but they go, we raised our target from $1 to $40. Well done. So it's like, well done. You raised your target from $1 to $40. This was actually, which one was it? Yeah, Wedbush. They raised their target from $40 from $1, but maintained their outperform. So, I mean, but guess what? Like, you know, they don't have a portfolio like that is being tracked with all of their analyst recommendations. So it's all right for them to do that. So with ARK, it could have been the same. But when they're actually putting their money where their mouth is, just shows timing is everything. Doesn't matter if it is the next biggest thing, which it might be. But anyway.
Yeah. You know, I wanted to get your thoughts on one of the interesting themes right now in terms of mortgage rates, right? Do you think there is a mortgage crisis brewing? You know, they're saying that we're getting at the same kind of debt to income ratios as 2006. This thread was quite interesting, saying that the down payment is actually lower than it was in the mid 2000s bubble. Obviously, we had bad mortgages in 2008. Deposit to debt ratio is going back to those crazy levels, right? So what's your take on this?
You know, it all comes down to jobs. Now, the thing is that 40% is pretty high, but people have got the jobs and they can pay for it. As long as they can pay for it, we're fine. But as soon as you start seeing layoffs in the job market and you start seeing unemployment start ticking up, and then, you know, for example, a lot of people that are buying these houses that have 40%, you know, their income is going towards their mortgage. And it might be based on, you know, 2-3 incomes in a household. And let's just say one person lost their job and that 40% turns to 80% all of a sudden, you know, then things start getting really interesting. So I think everything right now, and why all of these forecasts for recessions. I mean, how many recession forecasts have you heard? It's going to come, you know, soft landing. Oh, this is going to happen. This is going to happen. And it hasn't happened yet because the labor market is just so strong. And the thing is that despite a lot of people struggling, they're struggling with a job and can afford to pay for it. So they might not have much disposable income at the end of it, but they can pay for it. And if you look at past recessions, it was all accompanied by job losses. And that's why this whole move is pretty much 0 to 5 and a bit percent. And not just the Fed, it's the global economy, and the ECB, the BOE, everything. But the thing is that while this whole 5% massive move up in interest rates has happened, jobs haven't really come up, and it's robust and strong, and demand is still there. And again, you look around here, these restaurants are packed. You know, like, I mean, I went and, you know, Monday just went to a burger joint, like $160, just like that, you know. And just, what do you do? Just pay for it, you know. It's just, this is the problem. And until that stops, and you know, I just don't see it. But again, I'm not saying it can't happen, but until people start losing their jobs and just really the consumer really starts to being put under pressure, then I don't see this housing thing really being a big deal. But I mean, of course, it's a big deal. But remember, especially in the States, everybody refinances as soon as rates come down. So this might be the position now. And these people that are taking these 6%, 7% mortgages out, and let's just say the Fed starts cutting rates and it goes to 3-4%, and those rates go from 7% to 5%, everyone will be just remortgaging. And the next thing you know, it will get back into a line, into a better percentage. So that's what I see, but watch the space.
And what's your thoughts on Twitter? Obviously, you're a big user of Twitter. If you have more than 15 million impressions over the last 3 months, now you're able to monetize your tweets going back to February. And in that, you know, loads of creators are getting paid thousands of dollars now just for being on the platform. So what's your thoughts? Like, do you think that Meta now really has to kind of step up and try to like really start paying their content creators as well, and it becomes more of a equitable exchange? Because right now, you know, with pretty much most people who post to Instagram or Facebook or anything get nothing. It's a big change to Twitter, right? So
firstly, what I would ask everyone is to subscribe to Money Discourse so we can get to 15 million impressions, because right now get 300, 154, got 741 on this one. That's not bad. But anyway, it'll be great if we can get to 15 million impressions. So please like and please subscribe. There's actually good content, you know. I would, if I wasn't doing it, I would be definitely subscribed because there's some good information on there. But again, like you were saying, Meta, they're making too much money. And the thing is, the creators do get paid, but I think Twitter shaking it up like this is going to get creators asking questions. And again, creators are the ones that are driving a lot of the content to Instagram daily and stuff like that. So I feel like everybody, I mean, if you think about it, Meta's copied everything. So it's only just stands to reason that they'll copy this too, because that's their sort of MO. They just see what everyone else is doing, see what works, and go, right, I'll have a bit of that. And then, it's the same thing. So I think for Twitter, it's a good thing, because with Twitter, like having used it for a long time, there's no real incentive to do anything really creative on it apart from talking smack about politics and finance. But it's not really the place to go to for anything else a lot of the time. Oh yeah, and live sports reactions, like when Messi scored yesterday that goal, Twitter was alight, and that's the first place in my mind. I didn't think to myself, let me go to Threads, although I don't have Threads. It's like I just want to go onto Twitter and just see what everyone's saying. And so it's like, yeah,
it's always about attention, isn't it? Like no matter where you see all these guys who go viral, that you see so many of these creators just like put up one post and they go viral, and then they get these deals from television networks. It's all about attention, isn't it? So like who cares if it's reading smack or politics or whatever it is where your eyeballs are, right?
This is the thing. This is, I was thinking like, I'm trying to be as neutral and just, write stuff just how it is. But like we see it all the time, but it's like everybody goes, Tesla competitor having issues. Like, why do you have to say Tesla competitor? It's just the way it is. Like, I'm going to start every single tweet with Britney Spears naked and gross, and General Motors reported a 5-cent beat. It's like, but it's everyone does what they have to do. This clickbait world we live in, this is just what works. So, but I do definitely think it's an interesting thing. But more than that, like with Twitter, they have to do something, because again, despite it having a lot of engagement, it's just not making money really, if all these reports are to be believed. And it's very hard to make money as a social media company. You see Snap, it's still just hovering around. Twitter was always just around the break-even mark. It's basically Tesla and Google just still make all the money. So so this is what it all comes down to. So it's whatever works, whatever drives the advertisers back in, whatever drives the content creators in, you just got to do it if you're in that sort of predicament. So there you go. Yeah, it's going to be an interesting week. Lots coming up. Lots of companies to report, and so we'll go for a few of them next time. And join us on the next one.